Thank you everyone for coming to the webinar. My name is Mike Farlow. I'm CEO and President of ComTech, for those of you that may not know me. And on the webinar, we have Hunter Farlow, even though it shows Ethan in the picture there. Hunter is being our moderator for today. He's using Ethan's account, and Garrett Turner is our customer success manager, and he's hanging on here as well in case y'all have follow-up questions for later on. And what this is about is I have been fortunate enough to work with an industry expert, Greg Crabtree, who is on the webinar here. And this is unlike any webinar that we've ever put on. We are always tech related, security related, that sort of thing. But I heard Greg talk a couple of times at a couple of different events, and I've actually solicited his services as a consultant for our company. And I'm just blown away every time I hear him speak about what he sees in the industry and what his visibility is. I don't have a bio sheet on him. I just thought I would just describe real quick what I know. He is an author, he's a speaker, he's an entrepreneur, but the unique thing that Greg has that he brings to the table, and why I think the information he has is so valuable, is he works for one of the largest and most prestigious CPA firms in the country. So he literally has his pulse on what's happening in the American business world, small business world. When you see reports on the news, when you see government reports, those are things that are compiled over time. He's seeing the numbers daily as they come in real businesses just like mine and yours. And he's got some great information to share. So Greg, like I said, I could have read a bio, but
that's all right. Yeah, I appreciate it.
That's what I've got. So
yeah, that's
so,
right. Well, that
is
from
accurate. There, sir.
Yeah. So so appreciate you guys having me. So I mean, I love doing these because, you know, like I said, we do get to see a unique set of data that we've decided to pay attention to and aggregate and report on, because it's just not something that you see, you know, common in the business environment. So so happy to share that.
Greg, if I could pause for a quick second, I promised I would mention, I think everybody's familiar with how to use Zoom, but there is a Q&A button in the portal. So do click the Q&A button, not chat. Click Q&A if you do have questions, and we're going to address those throughout the presentation and at the end. And I'm sure you'll have plenty. So just make sure you get those in there, and we'll get answers for you. So didn't mean to interrupt. It's no all worries. You, Greg. Yeah. Go for it.
So as Mike said, you know, I'm partner in charge of the Huntsville, Alabama office of Carr Riggs and Ingram. So I had my own practice since 1986, and we merged in January of 2020 with Carr Riggs. They're a top 25 U.S. accounting firm. But largely since we merged, we're still doing what we've always done. And what their particular interest in us is that we have a unique consulting practice that is not geographically based. 90% of my clients are not in Huntsville, Alabama. So we do work all over the US and internationally as well. We're growing base of clients in Canada and Australia and other expanded places as well. So what I found in my travels and writings is that business is business, and there's things that we've come up with and concepts in our Simple Numbers series of the 2 books that I've written on what we believe about business and how to run a profitable business. Well, the advantage of that is that in the process of writing those books, we developed data sets of client data that we use for analysis and forming those opinions. Rather than just having an opinion and finding proof text for it, we said, well, what does the data tell us? And then what do we do about it? And so after I wrote the second book, Simple Numbers 2.0, we decided to keep that data set going. And a lot of what I'm going to share with you to set the stage, and then what do I do about it discussion following, comes from our what we call our simple numbers 100 company model. So we have a 100 company model that we monitor and update monthly. And I'm going to show you the data through December of 21 that I think you'll find kind of interesting. And it's about $1 billion of revenue. It's all different types of businesses. It's not geographically centric. It's from companies all over the U.S., all different industries. So we think it's a good basket of information to what's actually happening in the U.S. economy, and that'll be the kind of the basis of our decisions from that. So kind of to start off, to set the stage, here's you've seen on the news and people talk about business one thing or another. Well, I can tell you the economy did far better, at least in the private business sector, than what was widely reported during COVID. Yes, there was a handful of industries that were particularly affected, but for the most part, even our clients who were in those affected industries got through it. We didn't have any business go out of business during COVID. And not to say that there weren't some that did, but in our case, they didn't. And many of them actually had quite successful years. And so kind of depending on the industry, whether or not you were impacted by lockdown or those kind of things, people were actually able to navigate that, reasonably well, but still with some challenges, but it was still navigated. I got news for you. Inflation's real. It's going to continue, and I'm going to give you our reasons as to why we think it's going to continue. The labor shortage is permanent, and I'll give you kind of our reasons behind why we think that's the case. And the math is pretty daunting. Supply chain issues, continue. We're actually now, in some of the recent data that has come out in the last few days, we're now in this, what they call the bullwhip effect. You're actually going to see two different occurrences in supply chain over the next couple of months. You're going to see an excess supply of probably useless goods, and you're going to see still a shortages of key, core items, but you're going to see some items that actually have been oversupplied and will catch up. And so it's really going to be an interesting time in terms of people understanding. You'll actually see some people dumping product just to get their inventory value back and get their cash back because they over ordered in a panic, but yet those goods don't catch up and don't show up overnight either. And so it's really kind of if your business relies on inventory or shipping issues, you got to really work hard to kind of do predictions of where things are going to land, and you got to be thinking 9 months forward, not 9 months backwards. M&A market, a lot of you might be in the situation of considering selling your business at some point. There's just tons and tons and tons of cash out there trying to find a place to go. The private equity guys keep moving downstream in terms of size of business that they're having to buy up to then aggregate to then flip. So that market continues to be active. Plus, they're moving into other markets from a standpoint of typically businesses that previously didn't get premium values are now starting to get premium values just because that money is trying to find a place to go to deploy itself. Part of this is based on this next comment about the stock market. I mean, I'm not a stock picker, I'm not a stock portfolio manager, but I do have to pay attention to it. And when you look at the price to earnings ratio, PE ratio of the market, it's generally been averaging about a 30, and that's an average of the indexes. Sometimes it'll bounce a little higher, bounce a little lower. You got some companies that are way crazy high and some that are kind of neutral, but the average of the portfolio is about 30. And here's what that means. The stock market fundamentally is absolutely overpriced, but it doesn't mean it's going to go down tomorrow. It's because basic laws of supply and demand. Every week there's 401k withholdings that go into mutual funds that then the next week go to buy the least ugly stock. And essentially, because until there is a secondary investment other than publicly traded stocks for mutual funds to buy, i.e. bonds, and there's not really an effective bond market at the moment, given interest rate management by the Fed, you're going to have this overpriced stock market. Probably realistically, the indexes should average 15 to 18, somewhere around in there. But I don't think it's crashing tomorrow, but it is one of those things of understand why it is there. And so every stock moves to the top as being the least ugly in terms of its performance economically. And then as people overbuy it and run the price up, it starts to become ugly and it goes to the bottom of the stack and the next least ugly stock rises to the top. And you just kind of have this constant rolling fruit basket turnover, that you're going to see. Here's the other issue. There's not enough stocks for people to buy, and this is the other thing that's driven it up. If you actually look back to the 2020, or you look back to the year 2000, there should be twice as many public companies today as there were or based on today's economy. If you look at the rate of the quantity of public companies in 2000 versus what there is today. And a lot of that is largely for the reason of why the M&A market is harder than ever. It's because private equity now exists in an environment that does not have the burdens of public company oversight and public company cost and interference and those things. And so you no longer have to go public to get liquidity. You can raise capital in a private equity situation. They're paying the same multipliers, if not higher, that public companies would previously pay to buy a company. And so there's not a necessity to go public. Now, there's still people that do go public, but there's generally about as many people that go private once they go public as are going public. And so that number is staying relatively, low, to the size of the economy. And here's what it means for the people that are on this call that are business owners. You are now the dominant part of the U.S. economy, not the public companies. I mean, we've seen this dramatic shift since probably 08 was really where it accelerated, is where there's now, it's the private company sector that is the driving force of the economy. And so just keep that in mind. And really, when you think about it, it's really one of those things that, we have to use different techniques to understand what's going on now. The last thing I will say, and this is what I actually start the Simple Numbers 2.0 book, my second book, with, is this idea of figure out what the 3 simple rules of business success is: figure out what the market needs, find a way to do it profitably, and then make sure that profit equates to an appropriate return on invested capital, which we think is 50% or higher, in to be an appropriate business. And the idea of that first statement, it sounds simple to figure out what the market needs. But right now, there's tons of unmet need in the marketplace. I mean, services at an all-time low. There's products that are out of stock or unavailable, features and benefits of things that customers want that they're not getting. And it's an unusual time in the marketplace. And if you have the unique ability to deliver a product or service that is either in short supply or not available in the broader market, you have an advantage to take advantage of in the marketplace. So just keep that piece in mind. So let's talk about data for a second. So this is a chart that shows, the orange line shows the U.S. GDP data across time, and the blue line shows what our 100 company model was actually doing. Now, first thing I will tell you, first thing I ask the audience is, how much does the government know about your data for 2021? What do they know about your business? And the answer is nothing. They don't know diddly squat about what your business did. And and when you start to think about that, well, how do they get these government economic statistics? Well, they take the publicly available data and they make basically guesses off of it to extrapolate into the part of the economy they can't see. I got news for you. They're missing it. They're missing it big time. Because if you look at this chart, this 100 companies makes up about $1 billion of revenue. So it's a good data set. These aren't piddly, companies. These are, we try to take a nice basket, but the average is about a $10 million business. Some are higher, some are lower, but it's $1 billion of revenue, which I think gives us a pretty good picture of what's happening. If we go back to 2014, our data set showed those companies grew by 20%. The next year they grew at 14%. The next year was 15%. The next 2 years were 22%. And then in 2019, what I want to point you to is that group dropped to 8%. Now, here's the thing, let's reset history. Finishing 19, going into 20, that's when COVID hit. And you see the drop, our drop still kept it above zero. There was not a recession during COVID. Economics, went ahead. And this number does not include PPP as income. This ignores that. The government statistics, it kind of gave them some cover of smoothing their data so that they actually were able to break away from that a bit. But you can see that they showed that it was about a 3% decline. And then they're showing about a 7% growth in 21. This was an early release of data that we had. We were showing about 19%. It actually ends up at 26%, which I'll show you in the next slide. The point I want to make here is the fact that there's a great disconnect, between, what's happening in the economy. And more importantly, I want to draw people's attention to, this data point, right here of 2019. And when we're looking at that data point, what I'm telling you is we saw this happening right before COVID hit. And that's when we ran out of labor in the US economy. If you go back and look at the fourth quarter of 2019, you're going to see the lowest historical unemployment rate the country had ever had at that point. And now it all gets blown away by the next quarter because COVID hits, there's people being laid off, there's quarantines, and everybody kind of lost their footing. But I'll show you some slides here in a moment that will show you kind of that trend and when that inflection moment occurred. But let's look at some of the raw data. So this is the raw data in what we call our simple numbers P&L format. So one of the things that makes it easy for us to aggregate data is when we do consulting work for a client, we look at everybody's data in exactly the same format. And, when I'm talking to a group of business owners, I always find it kind of humorous. I said, if everybody takes their P&L right now and puts it on the table, we would be like the Tower of Babel. We wouldn't be able to communicate because everybody's P&L looks different. And I'd put this here and I put that. We don't do that. We have a definite way that we see business economic data, and we've kind of developed this format that we look at every business regardless of the industry in. And it really gives us some really strong understanding of that data. And one of our key principles that we focus on is we always isolate labor in the presentation. And so when you're looking at this data, you'll see that, we have direct labor, that many people will have up in cost of goods sold to get to their gross margin number. We split it out. And then you have management labor down here of everything that's not direct labor. And the way we describe that, we always make the statement says our rule of thumb is never, ever, ever mix labor with something that's not labor, because labor is the only cost that comes to work every day with an attitude. It has good days and it has bad days. And it's not consistent. And so one of the challenges that the economists have, and I appreciate the challenge that they face, is the fact that labor output is not a consistent measure. It's hard to count. When you have essentially, businesses, that produce widgets, they produce goods, you can count, okay, I delivered, this many, widgets, of this product. But labor, I mean, like I said, your guys, sometimes produce some good stuff and sometimes, sit around and lean on the shovel. And so it's really hard to measure, and I can appreciate the challenge, that faces, and I don't know that I've got a good answer for it. But in this model, what this model does show us is essentially, we had 26% growth in 21 over 20. We had 6% growth in 2020 over 2019. And so those things continued. Now, I'll point you to the fact that also we had 22% growth in direct labor. I will tell you that for the most part, I don't think our clients added a whole lot of headcount. I mean, it's hard to count bodies as well because people have different rates of pay, different roles. Businesses constantly, ebb and flow in role assignments and those things. And sometimes you got part-time people and all that. But at the end of the day, I will probably tell you that my assessment, just from our team having monthly calls with our clients that we aggregate this data from, is you're probably looking at real inflation closer to 15%. And that, I think that part is going to continue, and I'll build the case on why a little bit later. And when it comes to management labor grew at 15%. Now, these are things that I will say that over time, I'm going to tell you that most of that was probably just rate increases and not additional, bodies. And the fact that probably that pressure on management labor is a little bit lagging. It's actually probably going to hit you a little bit later, in that process. And in a couple of data points I'll give you, from the direct labor side. I mean, we've got a client in South Georgia that's a plastic extrusion manufacturer. And they were paying $13 an hour for line workers in 2019 and had a reasonable supply of availability. Today, they're paying $18 to $20 an hour with a $2 an hour shift differential for second shift, and they can't fill up the second shift. And so, I mean, that's a 40% plus increase in a 2-year period, which is over 20% a year. And one of the things that you're finding is, as the bottom end of the labor market has these really big percentage increases, it's going to continue to have a rippling effect throughout the rest of your labor base, because there's a natural gapping that has to occur between positions. And one way or another, it's going to filter through if it hasn't already. And we've already seen significant uptick in terms of technical positions of limited, capabilities, people in the, engineering sciences, accounting, finance, all of those things. I mean, those anybody with a hard to acquire technical skill set, are getting to write their own check, in terms of what they can ask for. Now, there's a little bit of a surge effect that kind of gets things caught up, and then things settle down. But I will tell you, you're probably looking at, just be prepared, I would say at least a 15% increase across the board, pretty much in what you will need to manage too. Now, which is going to make you sharpen your sword a little bit. You might limit some of those and swap positions, but just be prepared for that. All right, Mike.
Yeah, Greg, I just wanted to point out to everybody, you see, all of a sudden, you see exactly why I'd said this was for business owners and CFOs, because we're really getting into the meat of the financial numbers here. In his book, he does describe exactly what direct labor, contribution margin, and some of these terms are that you may not be completely familiar with. I've been working with Greg for a while, so this all makes sense to me. But some of those terms may not hit home with you, and it is definitely a different way of looking at your numbers that really makes it much more clear. Or at least to me, it was. I mean, I'm just an IT guy trying to understand these financial numbers, but this really helped me a lot. So I just wanted to let you know it on the book that I'm going to send you. It explains this. So
yeah, I appreciate it. Yeah, and really, I mean, we call it simple numbers for a reason. The idea being, I mean, revenue is the top line. I mean, that's where everybody's stuck. Revenue is the weakest number on your P&L. I mean, it's just a starting point for math. Gross cost of goods is anything that's a pass-through cost, anything from a material, supplies, or subcontractors that you give away a piece of your work to somebody else. That's cost of goods sold, but it doesn't have any employees to you in that. Gross margin is, revenue minus cost of goods sold. Gross margin is the true economic output of your business. That's the true economic top line. And if I had one wish for all businesses, I would have them all forever eliminate the discussion of revenue and talking gross margin only, because that's really the number that matters. Many of you have businesses that might have low margin percentages, and people are always talking about, big phenomenal sales numbers. And it's like, well, big whoop-de-doo. I mean, how much margin did we get? And when that margin varies from product or service that gets delivered, that becomes an extremely important issue. And it really, the core principle of how you create profitability in a business, we believe, is the action of labor relative to gross margin. It's keeping the relationship of labor to gross margin in every business, and managing a business much like an NFL team manages to the salary cap. If you're a sports fan and you're familiar with the NFL salary cap concept, essentially all 32 teams pay exactly the same amount of wages. Well, why is it that a handful of teams disproportionately make it to the playoffs and win more than others? They're better at acquiring labor at the right amount to create the output, that they have. They have better output, but they all spend the same dollars in that process. And business has to be the same way. There's physics related to every industry, that there's a multiplier effect. And that's what, this concept of, you'll see this term that we have in here that I describe in the book, direct LER. LER is labor efficiency ratio. So I'm just looking at gross margin per dollar of direct labor. And so as we look at the last 3 years of this model, this data set, it's pretty close to the same number. Last 2 years has been $2.71. So for every dollar of labor I invested in, I got $2.71 of gross margin. When you look to the right, this is what worries me, is I see two warning signs. Number one is gross margin percentage dropping from 46% to the last 3 months, it dropped to 43%. What that tells me is we're not pushing pricing fast enough. We're getting hit with price increases of our cost of goods sold, and we're having to eat it in some cases. And that erosion of 3% gross margin is massive, because that falls straight to the bottom line. Secondly, we're seeing labor efficiency ratio drop to a 2.6. And so once again, same thing. We're seeing this erosion of, whether it's pricing or productivity, it can be both. We're not getting enough gross margin. So when we teach profitable business principles, we're really striving to set those gross margin targets of production based on the labor you're committed to this month. We're halfway through April. You have some idea of actually what your labor costs are going to be this month. And you definitely will know what they're going to be 1st of May. And so the idea is there's a definite amount of gross margin that you have to find a way to go get. You can't wait to the end of the month and look backward and say, did we hit it or miss it? Okay, well, let's try harder next month. That just isn't going to be acceptable in a dynamic changing economy. You have to go make it work week in and week out and stay on task, stay on target, and communicate, to the team and say, how do we stand on that progress? And are there any adjustments that we can make? And, because it's always been difficult to adjust labor, but it's even more difficult now because you're always afraid to let unperforming labor go, because it's like, well, what can I replace them with? But if you got good labor that maybe sales are a little weak, it's like, well, I'm going to need them. And it's like, well, you better then get super focused on to go drive that revenue and go drive that production. But what we find is the companies that have this data and have it on a regular basis perform at a higher level, and they're able to go hit those targets, month in and month out, in that process. All right, well, let's hit a couple of more things. I'll skip this. Let's go to this one, and I want to draw attention to this 2019 effect. So this is a 2-axis graph that the blue line represents. Revenue on what we call a rolling 12 basis, and so every data point is the previous 12 months of revenue, and then the orange line represents all labor. Now, this is a 2-axis graph, so the labor is based on the left axis and the sales number is based on the right axis, but it makes them relational to each other. And essentially, during an expanding economy, what happens is revenue goes up and you backfill labor. Revenue goes up and you backfill labor. Revenue goes up and you backfill labor, until you get to right here. And you can see this blue line planed out at the end of 2019. That's where you hit the wall, and all of a sudden, labor caught up and said, nah, there's not any more labor to go get any more revenue. And then COVID hits, and we kind of muddle along till about the 4th quarter of 20. Then all of a sudden you see the labor shoot up. And this is where we're at today. Labor goes up, we adjust prices. Labor goes up, we adjust prices. We're not producing anymore. We're just raising prices. And the thing is, if you think about it like this, I can't produce more unless I have more labor. And it's just physics. And the other thing that really worries me about this is you see this increasing amount of labor and revenue here through 21. Look at what happened to rolling 12 profitability all of a sudden. Now this line was drifting up like it should, throughout most of that growth. But then when we get into this really high inflationary cycle here in the last half of 21, you see profitability flatten out. And it's because we're not keeping up with pricing adjustments to the market. We're getting hit every time we turn around by something that we can't pass through to the customer, one way or the other. And so you got to be extremely, extremely sensitive, to that. So just understand the basic laws of supply and demand. Assuming we don't have any lockdowns or price controls, I don't think they'll implement price controls, but lockdowns. I am concerned by what I'm seeing in Shanghai and in some of the China cities that they're having more COVID impact again. I mean, who knows? I mean, it could happen again. I mean, we'll see. But irrespective of those things, let's assume that we don't have those things again. You just got to go back to supply and demand. And as long as demand exceeds supply, prices will rise. It just is. And so look at your business and say, where do I fit in the world of business? Am I a common good that is sometimes going to be in excess supply and sometimes be in short supply? And when I'm in short supply, I need to make sure that I charge enough to recover, because when I have excess supply in a common good, I've got a discount probably to survive. And we may see this in this bullwhip effect of some excess goods now that are finally catching up that people over ordered. You're still going to see shortages, and we're still short of chips for cars. So now there is some indication of some of the things I was reading this week that some of the used car inventory is starting to fill back up again. I think some of that is just a little bit of speculative stuff that people that had an the extra vehicle or something are selling those in the market just because they can, and people are paying stupid amounts for them. But you may start to see that moderate, and the fact that how much more demand is there? There's generally not going to be a whole lot more used cars until there's more new cars coming in, and there's starting to be a little more supply. But I can tell you, all of the work vehicles, we've got clients in the work vehicle industry that do upfits, for work vehicles and chassis, and they still can't get enough chassis. They got far, far more demand, for work vehicle retrofits that they just can't get the chassis for. And so, we're not anywhere close to being caught up on those guys yet. So there's still some lag, in those things. The furniture industry has been just totally decimated. People that used to live off of the, go in, order your furniture, have it delivered in 4 weeks. I mean, you're still looking at 13 to 18 weeks, even if you can get it, from the furniture suppliers. So a lot of those are still hurting, from that standpoint. So just kind of keep an eye on those things. Here's my argument about labor, though. In 2001, we had a 2.4 replacement birth rate. Today, it's 1.8, probably dropping still to about 1.7. There is no 20-year crop of humans coming to save us. And if you really want to read something shocking, just go on the Wall Street Journal site and search for the article on Latvia, and it will give you a picture of what a declining population economy looks like. And it's not pretty. We've never been here before. We've never not had excess labor. And, I don't know about your hopes and dreams, but I don't think that we're going to get a comprehensive immigration policy that both parties can agree to and effectually, execute on to help solve that. I mean, it would be helpful if we could bring those people in, that are the right people and not just the random person who does, sometimes cross the border, but at the end of the day, I'm not pinning my hopes and dreams on it. And so the challenges here is, this is going to get worse before it gets better. And you just have to, my last comment there is just because I fly a lot. I mean, it's just absolutely disheartening to see, businesses shut, limited hours in airport services. It's better in the last month or two. It's still not back to where it ought to be. And these are jobs that, we're faced with an economy right now that if you're in a business that has a hard job, a dirty job, I mean, it's no telling what you're going to have to pay up to finally find the equilibrium to where somebody's going to be willing to do that job. And you've got to then price it in a way to say, well, if my labor is this, then my price has to be this for me to run a successful business. And you're going to see certain services and things become limited in availability because there's just not a worker willing to work it at a rate that the buyer sees value in. Now, you're going to see some jerkiness of people will push a price of a product or service. There'll be softness in demand temporarily until people realize, oh, wait a minute, that actually is the price and they're not going to discount it anytime soon. Okay, well, I'll pay it, and because you need it and you have to have it. And these are things that we're going to have to grow accustomed to. And the thing is, the rest of the world has dealt with this. I did a talk one time in Buenos Aires, and it's the only time I've ever been temporarily stumped with a question, from the group I was talking to, because I'm a big fan of having cash. You need 2 months of cash is one of our core principles of running a successful, fully capitalized business. And these guys, they question that logic, and I said, well, why is this? Is well, we have 20% a month inflation, and so at 20% a month inflation, you don't want to be sitting on a lot of cash because that cash is going down in value every day. Well, the answer to the equation is, well, I have to store my idle cash in a more stable currency. And so now the thing is right now, probably the rest of the world is inflating at roughly the same rate as well. I mean, we're not the only ones with this problem. It's the developed world that has this labor shortage. And one of the things that really shocked me was we had this futurist speak to our CRI's partner conference back in January. And he said, if you take a picture of the world and a flat map, and you look at the orientation of that map, you'll see that England is always in the center and at the top of the map. And that's because, why was it done that way? Well, England was in charge of the world when that map was originally done. And that's just remained the perspective. And he said, we've got to change our perspective. So unless you're a flat earther and you believe the world is flat, last time I checked, most of us believe that it is round. And you can look at it from any direction. I mean, the North Pole could as easily have been designated the South Pole, depending on how you look at it. And he said, take a flat map of the world and turn it upside down and draw a line through the middle of it and start to look at what's on the top half there. And what you will see in the top half is that's the future of the underutilized labor. Generally Africa, South America, India, these are the countries that still have excess labor. And to the extent that you can access that labor, and many of my clients who can access remote international labor, they are pushing that noodle as far as they can push it. I mean, you just got to, because they're just, and it's not as much cost as it is, there's just a human on the other end that's actually more loyal than what we're finding in the US. Yes, there's still some cost savings at the moment, but it's more about just there is a person. And there's tons of businesses right now. We've got a client out of Australia that places virtual assistants in the US, and they staff them out of the Philippines. And and think about that in terms of business. A company in Australia sources people in the Philippines to serve businesses in the US. It's a small world in reality. But there again, I mean, they're finding ways of saying, let's solve those problems, from that. Now, here's how you win in the world of labor, though. Right now, if I want to win, I have to be able to rapidly develop talent that's slightly below my current need, that's very job specific, task specific, and I can do it in a very narrow period of time. No, gone are the days that I can afford to hire somebody and probably have them spend 2 years as an apprentice learning through osmosis. I must accelerate that learning process. I must create content. I must create validation of learning processes. But I don't need to teach them, world history. I need to teach them a very specific task that I can be profitable within a very short period of time. And then I can incrementally add, to that across time. But if you're the person that's got to go pay up for somebody with currently exactly what you need, it's going to be hard to be profitable with that. Strong culture, fair pay policies. Used to, if you had a strong culture, you could expect a 15 to 20% discount of what you could pay people versus what other people would. Today, you're going to have to pay what the market pays, and the strong culture is probably just going to allow you to keep that person longer rather than lose them. But you've got to be proactive, we believe, to go adjust people's pay before they come to you with a competitive offer. And you're playing from behind, if you wait until somebody gets a competitive offer. And then the last piece is, as you give those pay increases, you have to adjust your pricing as rapidly as you can. Gone are the days of long-term pricing agreements and those things. That you've got to keep your commitments relatively short, because this is not transitory. This is going to be here for a while. You're going to lose in labor. If you can't wait to train labor and have to pay the market price, you're going to get hurt. If you have long-term pricing agreements that are based on consumer price index, which is terribly flawed in its analysis of inflation, that's going to hit you. If you use the H-2B visa program, we like that program. It pays a fair wage to the workers, and they live like kings when they go back home in the 3 months that they're off. But the government plays political football with it, and you get your allocation of workers 1 year, but you might not get them the next year. And that's a pretty disruptive way to run a business. And really, if you rely on that $15 an hour wage base, you got to be able to pass through that cost. And like I said, my client that, was paying $13 an hour is now paying 18 to 20. He's had to tweak his pricing on those things that he manufactures. Now, the good news is he's doubled in size, because guess what? A lot of people are moving that manufacturing back on shore. So that's a good sign. But we still don't have enough manufacturing capacity in the U.S. And fortunately, we're seeing signs of a lot being built. But it can't happen fast enough, especially those chip factories that they're making. We need those, massively. This is something I would say that should scare us all to death. Essentially, that the top part of this map shows, the countries that China was the dominant trade partner in 2000, and now you can see the countries where China's the dominant trade partner now. I mean, China owns Africa for the most part, and you may say that doesn't matter. A lot of rare earth minerals in Africa. It does matter in the long run of things. And it matters because the more people they trade with, the less need that they have to trade with the U.S. A good bit of our disruption is probably intentional. It's not just supply and demand issues. If you want to follow someone on Twitter that has been spot on with foresight of these supply chain issues, it's got the Huntsman. You can search under the Huntsman or @man_integrated. This guy is the best follow in terms of, I get so much incredible insight that's unfiltered by news and political commentary that's really been helpful to help our clients see what's actually happening. And then the last piece before we'll wrap up with maybe some Q&A is, these are the most common pricing errors that you've got to work through to fix in your business. Number one is pricing bias. When we go through clients' data sets, when we do a consulting project with them to initially, start working with them, we'll look back at the last 3 years of business, and we're commonly finding a consistent percentage of margin across a 3-year period. And I said, well, I'll give you an A+ for consistency. I'll give you an F for pricing. And when you have a consistent percentage of margin, it tells me you're pricing to a methodology rather than to market. and you're leaving margin on the table because you didn't recognize when you could have charged more and received a higher margin. And then there's times where I need to charge less, but I'm getting more volume. And there's a balance of the two things. And as I said before, it's not about revenue. It is about margin dollars created. And every business, has a differential that, sometimes that extra dollar or two of margin doesn't really require me to do any more for it. But yet I can still miss it because I'm tied to a percentage mindset rather than a dollars mindset. And so getting out of this pricing bias, is a real key. And where most people get into pricing bias is the second bullet, is a cost plus mindset. Somebody asks you how much something you're going to charge for something, and you take your cost, add overhead plus profit, and say, okay, well, this is what I should charge. And I go, no, I mean, charge what the market will bear. And the way to break through this is, before you price anything, before you get into any cost analysis, write down somewhere what you think the customer will pay for that. And then go do your cost analysis. If you do your cost analysis first, you'll never get to the market value of what the customer would pay. And you become trapped in this cost thinking. The other one, looking at one price for everyone. It sounds easy. And the best example of this, I'm in this group called the Entrepreneurs Organization, and we got a tour of the old Georgia Dome when Arthur Blank bought the Falcons originally. And he was giving us a tour of the stadium, and he said he did this tour with them, and he was asking the ticket manager, says, well, how much are those seats down there on the 50-yard line, on the front row? And he says, well, they're $150 or whatever the number was at the time. And he pointed to the nosebleed seats and says, how much are those? He says, well, they're the same price. It's a lot easier just to charge the same price. And he looked at him and says, you're kidding. And about 10 minutes later, the guy was given his pink slip and he was fired. I mean, it's the dumbest idea ever because, it's easier. Well, I mean, if you've got that kind of thinking in your business, heads need to roll, because there is a difference. Every customer is different. Yes, you can have some consistency. I'm not saying that, but there are certain times that certain things need to be priced more. And the more that you work through that, the better. Keep in mind these unexpected cost increases. You can't just pass through the cost. You need to pass it through with margin. Every time you pass through a cost that you don't get margin on, you're destroying your margin production of the business. And those percentages are there for a reason, that if you don't accomplish them, it erodes everything else. And so I get it that sometimes that's the only thing you can do, but you really got to strive to where you can overcome that. Contract negotiation errors, or where you get yourself tied into where you can't make adjustments. Just watch out for those. Billing by the hour is really kind of a big issue. I always say, if you bill by the hour, there's only two possible outcomes. You either charge for your ignorance or you gave away your expertise. That's it. And most people bill by the hour just out of laziness. They're unwilling to spend effort to scope, and they're unwilling to manage to the outcome. And we think fixed price billing is the correct win-win for everybody, because the customer knows a price that you're committed to, and your team knows what they have to perform to. But if you're unwilling to spend the time to scope and improve your ability to scope, and you're going to miss it sometimes, but you're going to win sometimes. And our clients consistently that bill on a fixed price basis, where the average of the industry is hourly or T&M, those fixed price people make more money. But they're good managers to the outcome, and they're good scopers. This one kind of may surprise people, but also pricing in inefficiencies in the market. When we do price things, we have a tendency to use best efforts. I got news for you. Nobody has best efforts right now. And we were working with a client of ours that does the vehicle upfits I was talking about earlier this summer, and they were struggling with profitability because they were having to hire temp labor, and it was untrained labor. And I said, well, are you charging enough? And it says, well, these people are inefficient. I says, I got news for you. Your competitors are inefficient right now too. I said, I know it's a foreign idea, but in a stable, consistent market, no, you can't price in inefficiencies. In a market like we live in today, yes, you can. and you need to, because you're going to have it. And so you've got to look at those things of, shipping costs where you're having to pay storage fees because it didn't clear customs, timely enough that you had to store it for a month or two before it cleared customs. That's an inefficiency of the market, and you've got to find a way to recover it in those things. And really, the last item I'll say here is this idea. Many of you have done bundling of pricing over the years, and we're in a time frame now to where it may actually be more advantageous for you to unbundle things, sell the goods at whatever it costs you, but then charge a fixed price on the service component of whatever you're doing. And I can control the service component probably a lot more so. I know what my current people are costing me. I may not know what the cost of a raw material is when I quote it versus when it lands and when it gets deployed. And so I may have to start thinking a little differently to optimize that situation. And so, but those are the most common things that we see across our client base that we've had discussions with to help them think through that and say, okay, what do I do differently now, because of that. So cool. All right. Well, in the time remaining, Mike, any questions I need to weigh in on?
Well, if anyone does have questions about this, because if this did not stir up some thoughts, you must have fell asleep or didn't get enough coffee, one or the other. So please put them in the Q&A and we'll be happy to answer anything for you. I had a couple of things that come to mind there. I've seen this multiple times and get something out of it every time I see it. One important one that you brought is that bullet point number 2, cost and mindset. I ran into an incident the other day that just shocked me. I had a company come by. They do an inspection of our fire extinguishers here in the building. You have to have the annual inspection and such. And they actually came out, did the inspection, found a couple that needed refilling, took them back, gave us loaners, brought them back, and the whole deal was $67 was the total cost of the bill. And when I saw that, it immediately came to mind that she could have easily charged me well over double that, and I would have gladly paid it. I don't have time to go out shopping for fire extinguishers and dealing with all of this. That mindset is really important, that everybody takes a look at what services they're providing. And I know it varies based on the industry and everything, but sometimes you're just literally giving your services away, and in her case. But that was something that came to mind.
And I think it's a good point, because you're looking at it from the standpoint. So there's people that will use deceptive pricing practices. So one, I was talking to someone yesterday, and that a friend of theirs, I think a family member, had bought a set of tires and took a car in or something. The other people quoted a lower price for this set of tires, and they got to looking at the quote, and they were quoting a low price on the tires, but then they were 4 times above the alignment cost, because you had to get the tires aligned. And so those are deceptive practices. In your case, you're exactly right, because there's a product component and then there's a human component of travel and service. And once again, we've broken through this mindset of, many of us are paying $15 for a hamburger, fries, and a drink, and then $10 on top of that to have DoorDash deliver it. And who would have thought you'd pay $25, for an ordinary hamburger in lunch, but it's common. And it's because you finally figured out that, well, there is a value for that person who was taking care of it, and what did they have to be compensated at, what their travel cost and all those things. And I think there's a way to look at it to where the customer has the choice. If you want to self-service yourself, okay, well then, there was an alternative. You could have gone out yourself and probably not even got it for that same price. And so you're exactly right. I'm bad about, when I see that from companies that I buy from, I just smile at them and says, you're really not charging enough for this.
Right. Yeah, absolutely.
Yeah.
I did have a couple of questions came up
Yeah.
here. Do you have any idea of how this is impacting the trucking industry?
Oh yeah. Well, let's see. Walmart is now currently paying $100,000 a year for a truck driver. So if you like driving, they'll train you as well. So if you just like driving, just go down to walmart.com and sign up. One of my clients that was in a freight logistics company actually just sold last week. I mean, the trucking companies are in this state. So you take trucking and it's kind of feast or famine, and there's trucking companies as it relates to logistics where they're really just coordinating and selling loads. They're not asset based. And then you got trucking companies that they're actually managing the equipment. And really, when we think of those kinds of businesses, you separate the service itself from the cost of the asset. The asset has a definable cost to it over its useful life. And so essentially in every piece of freight, there's a portion of that freight cost that is a recovery value of the asset that it took to move it. And then there's a cost of the humans that it took to do the human, part of it. And so you're just kind of breaking it down in those things. And the thing is we're consistently being hit with greater and greater delivery demand. We become more of a remote economy. There's just going to continue to be that pressure of more and more trucking and shipping over land to be the last mile. I just don't see it slowing anytime soon. Now you'll go through a month or two where, okay, everybody's fat and I've overspent and I need to pause for a month. But okay, it'll be right back, and just be prepared for it. And I think every industry right now has to be more sensitive to these unexpected pauses until things reset, a month or two later. And there is an aspect that you have to be wise in terms of choosing to grow your business. And now more than ever, our philosophy, you've heard me talk about this in the talks that you've heard me do, we like growing out of your own profitability rather than trying to grow with other people's money. And so when you grow out of your own profitability, you can grow smartly. That's why the subtitle of the 2.0 book is Rules for Smart Scaling. And so if I grow out of my own profitability, I'm taking, a very careful risk, in that process. And generally I have a better recovery point. I have the ability to stay in the game longer during disruptive cycles. And that's really kind of the new state of business that I think people have to be more attuned to right now is having that ability to get through disruptive cycles no matter what industry you're in.
Obviously we're an IT business, technology business, and I hear some business owners, they're talking about, during this time of inflation, cutting costs, trying to eliminate expenses, which is always a good thing. I mean, nobody wants unnecessary expenses, but I find a lot of business owners, I don't know if you see the same thing, but they don't always look at ways to become more efficient or how to use the technology that's there. One example that we used is we went to an automated system, whether you like it or hate it, either way, we had to do it. But we went to an automated system for invoicing, bill payment, and so forth. And it cut my labor by 2/3 doing that. Now I can send out 200 invoices in 30 seconds. I'm not paying somebody to stuff an envelope, put money into postage, and go through all of that and deal with checks coming back in. It's things like that to optimize your business, I think, are getting more and more important. And folks need to really open their eyes and look at their businesses, because the way you did things 10, 15 years ago is not necessarily going to carry you through. You're the expert on this, but that's the way I see it. It's not going to carry you through the storm.
You're absolutely right. So you're exactly right that the Cro-Magnon entrepreneur thinking is, things things have slowed or inflation is high, I've got to cut costs. He's like, no, cutting costs is the worst thing you can do. And I got news for you. If you look at this data set, all right, let me just run through it with you right quick. If you take cost of goods sold plus direct labor plus management labor, that is about 85% of all cost in the business. They ain't enough, and you can't cut those others to zero. There's not enough other costs to cut. And so it ain't about cutting. I mean, granted, don't spend money on something that doesn't produce. I mean, I get that, but that's not when we break down businesses every day when we go through our consulting process, that's not where the issue is. The issue is I'm not producing enough gross margin for the labor that I'm spending, whether it's direct labor or management labor. And so the idea it is, what is the output? What am I getting for that dollar of labor that I'm producing? And your point is 100% spot on. One of the ways to improve the output of my labor is to get better at systems, processes, invest in technology. I mean, we didn't miss a beat when COVID hit in our office because we'd been using Zoom for years. And even before that, we used prior to even Zoom being created, we used a product called Join.me. We've been doing video calls with clients, and it's like, big deal. Now the rest of our firm, I mean, they weren't used to that. I mean, that was just something that we were already doing that. And it's like, okay, no, we didn't miss a lick of productivity. And
right.
And so those are the things that you've got to look ahead and say where, the quote about Wayne Gretzky in hockey. I'm not a big hockey fan, but I certainly know about Wayne Gretzky. And he said, skate to where the puck is going to be. And that's where, if you want to be the business that survives and creates great value, you got to skate to where the puck's going to be.
I appreciate it, Greg. I know we're out of time. We're already a little bit over. I could talk to you for hours and hours. We did not get to all of the questions. I'm gonna put those together, and if you'd be willing to perhaps reply back via email later,
Sure.
I'll make sure everybody gets a copy of the questions and the answers. I'm going to be sending a copy of the book out to all the attendees. Appreciate y'all being on here. And there'll be a recording of this as well that will be sent out. So you guys can look back on it, because I'm sure this was a lot of information. I hope you guys enjoyed it. Again, I know it's not our normal IT webinar, but this information was just so valuable. I just wanted to try to get it out to you guys. So hopefully you'll see the benefit. Greg, thank you again so much. That was so kind of you to be willing to do this for us.
Yeah, happy to do it anytime. Appreciate it.
Okay. Have a good one, everyone. Thank you for being here.